Imagine opening your banking app and seeing that your money is still there. The balance hasn't changed. Nothing looks wrong. But when you try to move it, withdraw it, or send it, you can't. There's no warning, no email, no alert explaining what's happening. Just a short message telling you to wait. This isn't a dramatic movie scene or a made-up scenario. This has already happened to people, quietly, without headlines. And the uncomfortable truth is that moments like this don't come out of nowhere. They are usually the surface crack of pressure that's been building underneath for a long time. A few days ago, I spoke to someone who works deep inside the UK banking system, specifically in risk management. This wasn't a public interview, and there was no agenda. It was just an honest conversation. At one point, he paused and said something that stayed with me. He said that the people inside the system are all looking at the same data, and many of them are uneasy, but no one wants to be the first person to say it publicly. Not because it isn't real, but because once it's said out loud, confidence changes, and confidence is everything in banking. The key thing to understand is that this isn't about banks suddenly being weak or poorly run. On the surface, most UK banks look fine. Profits are reported. Capital ratios are quoted. Everything appears stable. But pressure doesn't announce itself with sirens. It shows up quietly in places most people never look. In the details, in the assumptions, in the slow changes that don't feel urgent until they suddenly are. One of the biggest sources of that pressure right now is commercial property. Office buildings across the UK are far emptier than they were a few years ago. Remote work didn't fade away the way many expected. It settled in. But the loans written against those buildings were based on values from a different world. Those values have fallen, sometimes sharply, while the loan amounts have not. As refinancing dates approach, borrowers are discovering that the numbers no longer add up. Banks don't want to lend the same amounts against assets worth much less. Borrowers can't inject fresh capital, and that's how defaults begin. Not all at once, but gradually, loan by loan, balance sheet by balance sheet. At the same time, millions of households are facing a very different kind of pressure. For years, mortgage rates were extremely low. Many people bought homes assuming that those conditions would last or at least normalize gently. Instead, rates rose quickly. Fixed rate periods are ending and monthly payments are jumping by hundreds of pounds. The issue isn't just higher payments. It's higher payments combined with rising living costs, and in many areas, falling house prices. That combination removes options. Some homeowners can't refinance. They can't sell without realizing a loss. And they can't comfortably absorb the higher cost either. When enough households are in that position, the risk stops being individual and starts becoming systemic. Banks respond to this kind of environment in predictable ways. They become cautious. They tighten lending standards. They slow approvals. They quietly reduce risk. From the outside, this just looks like credit becoming harder to get. But credit is the fuel of the modern economy. When it slows, businesses feel it first. Not because they're failing, but because cash flow gaps become harder to bridge. Profitable companies can struggle simply because access disappears. Jobs are lost, income becomes uncertain. And that uncertainty feeds right back into the financial system. Many people assume that even if something goes wrong, their money is fully protected. And it's true that there are safety nets. But safety nets have limits, and they don't always work instantly. Protection does not mean immediate access. During periods of stress, systems freeze first and resolve later. Transfers can be delayed, withdrawals can be restricted. And even temporary disruption can have serious consequences if you rely on that money to live, pay staff, or keep a business running. The most important factor in all of this is timing. Financial stress doesn't give clear countdowns. By the time everyone agrees there's a problem, the window for easy action is usually closed. History shows this again and again. Early signs are dismissed because they don't look dramatic enough. Then confidence shifts quickly. And once confidence goes, it's extremely hard to restore. This is why preparation isn't about panic or dramatic predictions. It's about positioning. Sensible preparation looks boring. It means not keeping everything in one place. It means understanding limits. It means having alternatives. Not because you expect disaster, but because systems are complex and uncertainty is unavoidable. You don't wear a seatbelt because you plan to crash. You wear it because you understand risk. If nothing significant happens, being prepared costs very little. Your money is still working. Your life continues normally. But if stress turns into disruption, Preparation makes an enormous difference. It means options instead of urgency. Calm instead of chaos. Control instead of waiting. The banking system today is more regulated and more resilient than it was in the past. That matters, and it shouldn't be ignored. But resilience doesn't mean immunity. Pressure can build even in strong systems, especially when multiple forces push in the same direction. Commercial property, household debt, and tighter credit are not isolated issues. They interact. The real mistake most people make is assuming that if something is serious, it will be obvious early. In reality, the most dangerous phase is when problems are visible only to those who know where to look. That's when preparation is still possible. That's when small, calm decisions have the biggest impact. This isn't about predicting a crisis. No one can do that with certainty. It's about understanding that uncertainty exists and acting rationally before urgency removes choice. The people who handle these moments best are rarely the loudest or the most dramatic. They're the ones who quietly prepared while everything still looked normal. The question isn't whether headlines will change. The question is whether, if they do, you've already done the simple things that give you flexibility. Because once everyone is paying attention, flexibility is usually the first thing to disappear.